Good morning, good afternoon, everyone. Thank you for joining us today on a new session of PE Forum. We have the pleasure of welcoming today Omar Al Yawer, who is a partner at Ruya Partners. Ruya Partners is an independent private credit firm based in ADGM in Abu Dhabi that provides bespoke funding solutions to companies in developing markets. For those who do not know him, and he's very well known in the Middle East and beyond, Omar has more than 25 years of experience within the asset raising and equity trading across the world. His past experience with JP Morgan Asset Management, as well as Man Group, as well as Franklin Templeton Investment. So big names before starting a new journey with Ruya Partners. Omar, thank you so much for joining us today and taking the time.
Thank you, Khalid. Pleasure is all mine.
Omar, I just wanted to start, and discussing the idea or looking at the credit, private credit as an asset class. Where did you see, or how did you feel the need for it for the Gulf region and for developing market as a whole, that pushed you to, with your partners, to launch Ruya Partners?
Sure thing. Thank you. Thank you for the question, Khalid. What we do in private credit, we're really effectively trying to bridge a gap that exists in a significant way globally, but more specifically, even more significant so in the Middle East. And what I mean by that is, if you look at all the banks in UAE, there are over 54 banks. Saudi, similar numbers. There's one thing for sure we know in the Middle East, particularly the GCC, there's no shortage of banks. But what there is a shortage is the banks operating and providing loans to mid-market and small SMEs effectively. We don't do the S, we do the M. But what happens, if you look from a global perspective, if you compare all the banks' loan books in the Middle East as you compare it with the West, developed markets, what you'll find is that their overall allocation to SMEs is the lowest globally in the Middle East. More specifically, it's less than 2% of the loan book of any bank in the Middle East is to SMEs. Whereas if you look at our friends in the West, it's over 22% of any bank's balance sheet is in SMEs. So what that alludes to is the fact that there's a serious funding gap, because the banks here, they have two really main segues of revenues for them. Is they name-based lend, so they give to big families in UAE, Saudi, Kuwait, and others, or they give it to big government-backed projects. So if you're not from either of those buckets, not from merchant or royal family, and not from a big government-backed entity or government-backed project, it's very hard for you to get a loan. So case in point, our first investment was a company in UAE called Starsplay, which is effectively the Netflix of the Middle East. They had $150 million of equity, the likes of Lionsgate, the likes of GE Pension, Etisalat were all part of their equity rounds. Yet they had no debt on the balance sheet, yet none of the banks in the UAE were able to give them any additional growth capital via flexible facility. We did. And you'll see that over and over again. We're effectively bridging that gap. And the investment space is quite robust. And it's more now than ever that the middle market needs to grow with folks like us and a few others to help various governments achieve their visions, whether it's Vision 2030, Vision 2050, Vision 2040, all require the mid-market or the SME or the middle class to grow further.
It's a very interesting point. And if you look at, globally, if we take private credit as an asset class in 2009, and these are Preqin and Goldman Sachs numbers, we were at 300 billion in AUM. Today, the asset class has reached 1.9 trillion. So there is a need there's a gap for financing, whether it's in the West, Europe, US, or in the Middle East. Do you know what is the size of this asset class in the Middle East? And in your perspective, even if you don't know these numbers, how do you see it evolving in the coming years?
So it's a great question, Khalid. Actually, we do know it's a little over 150 billion in a funding gap. And that's based on World Bank numbers that it showcases the same figure that I mentioned about less than 2% of bank loans books are to SMEs. This is where the funding gap exists. Now, The real challenge the Middle East has had is not about having money. We all know we're well capitalized, particularly the GCC. So the real question is, why hasn't the private credit landscape in the Middle East grown in parallel to what's happening in the West? And the reason is actually lies on the underlying DNA of the various GPs or general partners or investment firms that have come and gone. We pride ourselves as Ruya Partners being the first and only partner-owned investment private credit firm. What we mean by that is myself and my two partners are the owners of the firm. We have significant part of our own net worth, both in the fund and in the firm. And what's important to investors to think about that is that in the West, whether if you look at on the private credit side, Ares, Churchill, GSO Capital, before Blackstone acquired them, all the founding partners are the founding partners till they're no longer on this earth. In the Middle East, what we've seen, GPs that are owned by a bank, where my partner and I, Rashid, started in the Middle East here with MBK Capital Partners, owned by a bank, or you can have an investment firm that's owned by multiple family groups or one family group. And so what you found is there is a really tough challenge to maintain the investment teams beyond one vintage, beyond one firm, beyond one fund. So what happens is you have an investment team does great investments, they have one great fund, then their reputation become known in the market. Perhaps a family groups in Abu Dhabi, perhaps a family group in Saudi open up and say, you know what, let us dabble in private credit. Let's hire that team or let's hire that lead. So you constantly saw a rotation of talent, which you don't see as much in the West, because the investment teams were not incentivized and they didn't have alignment of interest where we see in the West, where they have their own net worth in the fund, their own net worth in the firm. So they're able to be recruited to other places. So from the beginning, the reason I left JP Morgan and the reason my partners left where they were at Waha Capital was we wanted to build a Western style GP in Abu Dhabi. We want to not reinvent the wheel, just recreate it in the Middle East, apply the same strict guidelines to build a proper GP. All of us have to invest in the firm. All of us have to invest in the fund. So then when we make investments in an 8-year fund, we're not just taking investment decisions on you as the investor's money. We're doing it with our own money. And that's a very different way of investing. And that's why the likes of Ares, KKR, Blackstone, both on private equity and private credit, have sustained such a long, impressive track record, along with them being good investors, of course.
I mean, I agree with you. Skin in the game in when you talk about investment and private equity in general is a key concept, and it's good to see this changing in the region. In terms of sectors, do you look at where do you see growth? Why? Because at the end you have to bring return for your LPs. So what sectors do you look at, and what sectors do you avoid, if any?
Sure. We are sector agnostic. We don't believe that we should focus on any particular sector all the time. But what we do like is from time to time, depending on the macro story of what's happening in the most significant economies and the geographies we look at. So we look at Middle East and North Africa. However, we are a dollar-based fund. We're a dollar-based investor. So we tend to look at the dynamics of the two biggest GDPs in our region from a dollar perspective, which is Saudi and UAE. The sectors that we've invested in and the sectors that we see a lot of deal flow come through, it really has been energy, it's been consumer, it's been hospitals, schools. The only really sector we avoid is construction. And the only reason we avoid construction is because their costs, their timelines are usually very hard for us to predict a consistent cash flow. And so what we care for is cash flow analysis. The other thing important to highlight is the sectors that we look for, unlike our friends in the West. So when people say private credit, it's a big word. It's like saying finance. But what are the distinguishing factors? In the Middle East, there's a big difference from what you're seeing in the West in terms of private credit structure. What I mean by that, in the West, it's heavily reliant on private equity transactions. It's sponsor-led. So a private equity player comes in, wants to buy a company for 500 million. They need various parts. They're going to put some equity, but they're going to put some debt. So they go to the likes of Ares, they go to the likes of Churchill and other and say, give me here's a structure of the terms. Please give me your pricing. And that's usually how it goes. And so the private credit managers, while they do their own due diligence, they rely the heaviest lifting comes from the private equity sponsor. Look to our Middle East, it's a complete different story. There are no real private equity transactions happening in a meaningful way. And if they are, they're less than a handful. And so what happens is we actually source all of our deals. We do bilateral agreement with the underlying entrepreneurs in the respective geography. And we're covenant heavy. We do a full suite of covenants when we do an investment, whereas our friends in the West, because it's quite commoditized, it's covenant light. So they may have one or two covenants. We have a full suite of covenants on every single transaction. And that's a big distinguishing factor. And the other point I want to highlight is the fact that we use zero leverage. So the returns that we generate for our investors, the returns we target and we generate uses zero leverage. Whereas in the West, because of the advanced landscape, they can actually have their core returns coming from the cash flow, and then they can actually lever the fund, and then they get an extra 200, 300 basis points of returns. For us, we're able to match those returns without using leverage because it's still very nascent in its growth stage, and the opportunity set is billions of dollars worth.
And in terms of, sweet spot in terms of ticket size, is this something that you can discuss and divulge to us today?
Sure. Yeah, absolutely. Our sweet spot is usually our range, our investment range is from $10 million to $30 million. Our sweet spot tends to be 20 to 25 million. And what we do, because all of our investors are institutions and sovereigns from UAE and Saudi, a majority of them have requested to join us, not just in the fund, but also to bring them deals for co-investment opportunities. So unlike in the past, we've been investing in the Middle East for the last 15 years, by the way. We've made 35 investments in our previous roles as employees. Under Ruya, we've made 3 investments. So we look to invest between 10 to $30 million. Sweet spot is about 20, and across all geography. But really, if you ask me where are we seeing the most interesting deals, it's really UAE and Saudi. And to your point, a couple of questions earlier as to we were fortunate and we're humbled by the fact that we were able to gain some of the most well-recognized institutions in the region, like Mubadala Capital as our anchor, like Jeddah, PIF Jeddah Fund of Funds, Saudi Venture Capital, and a few other names that I can't disclose, but they're pensions and they're quite large quasi-sovereigns. All those institutions have been allocating to the West, the best managers. This is their first time allocating to a regional manager. So they did an 8 to 9 month due diligence process. They hired the likes of Mercer. So they've really did their strict homework before investing in us. They didn't just do it as a token to a local manager. If that was the case, they would have given money to others many moons earlier. But thankfully, the evolution of the allocator landscape has also changed. So there's a serious gap of funding that we're filling, or trying to fill. And the institutional landscape of allocators have now shifted the way they think. They're no longer just exporting their capital. They're also saying, if we want to achieve Vision 2030 in Saudi, well, we need to empower the local quasi-regional managers to invest in Saudi companies, UAE companies, because the areas in the world are too big to invest in these smaller companies, and they don't even have investment offices here. They have fundraising offices, which is the typical, GP expansion in the region. It's really usually a fundraising office.
Yeah, it's interesting because this is the question I wanted to follow up on is that by developing local talent and encouraging local development, these institutions are looking to develop the entire ecosystem. How do you see the regulation? Because getting the LPs from one side, but then investing in different territories and different geographies, because Saudi is different than the UAE. How do you see the regulation moving along with this new vision of growth and development?
It's an excellent question and an excellent point, Khalid, in that the 15 years ago, when we first started investing in private credit in the Middle East, it was not as developed as we'd like it to be. Now, fast forward to where we are today, and the IFC has private credit regime rules. DIFC, which we're one of the first few managers to receive their private credit license. And so what we try to do, we try to minimize the difference between the various jurisdictions. How do we do that? Regardless of where we invest, whether it's Saudi, Kuwait, Qatar, Bahrain, Egypt, we don't like to take any risk of doing things onshore where the laws might be different. We typically do structure all our deals in an English law jurisdiction, so ADGM preferably, DIFC, Cayman, so that we can apply English law to the agreement that we have between us and the underlying investee company. So if and when, God forbid, if things don't go as planned, we apply English law that's clear, that's consistent, and that's had precedence across our investments. And it's really been working quite well for the last, we've been doing this really for the last 15 years. But interestingly, these offshore jurisdictions have become closer to home. So ADGM, DIFC, whereas in the past, when we first started, Rashid, my partner Rashid, when he first started the first private credit fund in the region, it was really mainly Cayman because you really couldn't feel comfortable putting it in any place else. But like you know, like you see what's happening in particularly UAE and Saudi, they're really leading the way in evolving, making sure their financial centers are global, competing with global jurisdictions. And I think the best is yet to come. They're continue to keep changing and evolving and learning and making it a better jurisdiction, both in Saudi and UAE.
If we take the general environment that we are in today, there's a bit of a lowering within the inflation, but still, we faced quite some inflation, and we're looking at high interest rate levels compared to the previous decade. The Gulf region, you're in dollar denominated, sorry, and the currencies are pegged to the dollar. How has this affected your deal flow and your deal sourcing? Has it made it more difficult? You talked about covenant. Does it add to the measures or the protection that you take on?
Actually, funny enough, because of the fact, to my earlier stat that I shared about nearly all the banks in the Middle East, their loan book accounts for less than 2% to SMEs. That figure from the World Bank was produced about 4 or 5 years ago when interest rates were near zero. So when times were great, the banks here were not giving loans to the target companies that we were looking at. So imagine how they do when interest rates become higher. They become even more discriminate. So what you were finding is we're actually finding our deal flow, our pipeline couldn't be stronger. We see over $2 billion of transactions every year since we started, and we've only been around for 3 years. So we actually have more deals than we can handle. Now, not all deals in our pipeline are going to be workable. And give you an example, we are very, very particular on how much we spend and what time we spend on deals. So just because there's a $2 billion worth of transactions, our selectivity ratio, which is where from first handshake to finally actually investing in a company, it's between 2 to 4%. So between 2 to 4% of that 2 billion is what we actually spend time on and actually take it all the way to investment, which give you just an indication. But where we're seeing going forward, this is effectively with interest rates being as high as it is, as an entrepreneur, you ask yourself 2 questions. One, well, can I get bank lending? And if a company can get bank lending, they're definitely going to be better financing from just a rate perspective than us. Their cost of funding is a lot lower. However, the real challenge entrepreneurs face is not can I get bank lending or not, is if I don't get bank lending, how else am I going to grow? The only other way that most of the entrepreneurs in the Middle East have been growing is selling more equity in their business. And if you're a business that's growing 20% year over year, that value of your shares is worth a lot more than the higher rate you're going to pay us during the period where interest rates are high. So the real calculation when we are looking at entrepreneurs that may have not ever considered private credit, they think, well, it's too high. It's higher than bank rates. I agree. But the flexibility is far more important for those entrepreneurs. And when they see that if you're willing to take on a 5-year loan with these terms that is flexible, that no 2 deals are the same. So we make sure that the loan that we give actually helps the business grow, because it is not in our best interest to break the company effectively by them not being able to pay us the loan. So we do our cash flow analysis. All our investments are self-amortizing. So the company pays us back our cash, our PIK, and through without having any exit scenario, without an IPO, without somebody buying them out, without even reaching sometimes their growth plans. As long as they can maintain their business, we're happy and they're happy. And so that's kind of the reality on the ground, that banks haven't been playing before when interest rates were low. Now the interest rates are high. They even become more discriminate. Now they only do the likes of the ADNOC deals and the big deals that, to them, nobody's going to lose their job by giving loans to these entities. But try to go to a name that you don't know, and you don't have the team that does cash flow analysis, they're flying blindly, unfortunately.
Yeah, makes a lot of sense. I want to go back to a point that you mentioned at the beginning, which is, it's a region. The Gulf region is a cash-rich region. Let's face it. There's a lot of potential for investment, and you mentioned various, whether it's financial institution, local banks, and also families. What is your approach towards? Or do you see them as competitors, as potential LPs? How do you navigate the different, because these are big groups that have activities and conglomerates in many of them in many activities. So are they more of a frenemy, or are they more of a potential partner?
There is so much work to be done in the Middle East, and then there's not enough competition, frankly. And so we see them as in the allocator as a partner. We see banks as a partner. We see family groups are partners. Now, I'll start with the last first. Family groups can be partners in twofold. They could be LPs in our fund, naturally. The second is when we actually start to meet these heads of these family offices, the patriarch of the family, even the CIO, who may not necessarily be from the family itself. And then we walk them through what is it that we do and our track record of doing that, helping companies grow. All of a sudden, they go from thinking about us as, hey, maybe I'll invest in your fund, to say, by the way, we have XYZ company. We weren't sure if we want to put more money down ourselves on the equity side. Maybe we should actually put a bit of debt to help it grow to the next stage. So we find that some of these family groups actually are a great source for deals for us. We see that firsthand when we've sat on various boards. So my partners and I have been on various boards, both on the private equity and the private credit side of investing. And a lot of time, these board members show us deals who then, in their own right, have their own family groups. So the ecosystem of family groups is definitely one that we see both as a partner in the fund and a partner from a fund deal sourcing. In terms of the banks, while we would have loved to have these sort of partnership that you're reading about now, more recently, and where KKR has done that in the US, where they partner with banks and they take on some of the loans, and they basically purchase loans from these banks, good performing loans, not just the stuff that they're trying to clean their books from. You're seeing that actually just yesterday, KKR, if I'm not mistaken, bought 9.4 billion worth of RV loans from a Bank of Canada. Okay, the West is a bit more developed by the understanding between private credit players and banks that they need each other. In the Middle East, we'd love to see that develop, and I think it will. It'll take maybe one or two national champions from the respective geographies. So maybe one bank in UAE, maybe one bank in Saudi, to test the water, to say, hey, you know what? Let me speak with these handful of private credit managers and see, perhaps we can show them deals, because they're not going to do the type of deals we do. So at least it could be a synergistic relationship. I believe that will happen, but it hasn't happened yet. From them investing in our fund, that's also more of a distribution model. It hasn't really, hasn't evolved yet. And last but not least are the largest allocators, the sovereign wealth funds, the pensions, the endowments. What we're seeing is they've been a phenomenal partner in our growth. They've really backed us from a funding. They've been backing us in terms of connecting us with some of their underlying portfolio companies. So whether it's late stage venture or mid-market companies that they have in their portfolio, to say, hey, why don't you speak to that CFO? I think it might be worthwhile. So you're seeing an evolvence of open door policies rather than gates and moats. For the last 16 years that we've been operating in the Middle East with various entities, barely did you have this kind of synergistic dialogue. You had very limited give and take between the biggest allocators and the ecosystem of private credit managers and private equity managers. So it's because there are serious visions with impressive leadership that's making this a reality. And teams in these sovereign wealth funds, pensions, endowments, that actually want us to succeed, because they know if we make good investments, they'll earn returns as LPs, but also their ecosystem will benefit. So the companies in Saudi will benefit. And then it has a trickle-down effect to the entire economy. So in a sense, we are witnessing a renaissance in the Middle East that has not been witnessed since the discovery of oil. That is how significant private markets growth is happening right now. Within the last up to the next 10 years, we're seeing serious investments coming from the sovereigns, serious investment needs that are from the underlying companies that are benefiting from the growth, and GPs that are formed and forming that are using best practices. We don't want to have any of this unfortunate blow-ups of various GPs that have come and gone because of bad actors, right? Mm-hmm. Person that leads and there's no one to check his authority or her authority, but it's tended to be his, a couple of names that we know that have come and gone, unfortunately. Mm-hmm. We want to make sure that the growth continues with like-minded investors and allocators.
You mentioned as well, if we could continue on this point about how in the Europe and the US, private credit deals are in fact led by private equity firms, and the private credit comes as an add-on. Today, do you see the premise of this happening in our region, where you also have private equity firms, with the same spirit as you, with the skin in the game, with a modernizing view and with a drive to do something good for the region? Do you see a potential for this happening as well? And is there a timeline for that? Because it's an evolving environment.
One of the most exciting things in our space that we're seeing is this. Similar to how when I mentioned the allocators used to have moats and gates on, exchanging ideas and information and exchanging, hey, maybe this portfolio company can benefit from your loans. Or we're also seeing a much more friendly, proactive, and synergistic private equity and private credit managers or GPs speaking to each other. So whether it's our friends at Olive Rock in Abu Dhabi or Elif and a few others, we know each other. And all of us have really built our own track record prior to launching our own firms in different companies and different countries, but all within the GCC. So we all have come across each other wearing different hats, but usually it was an employee hat that we wore, all of us. But now we're all entrepreneurs ourselves. So now we meet and talk to them regularly. So if there's a transaction that they're looking at that might be a bit too large, they may not want to do the entire thing on equity, they'll show us some deals, and vice versa is true. So the last investment we just made in Gym Nation, which is the largest UAE gym chain, it was done on a combination of both an equity investment from a company called TriCap Investments, as well as us on the private credit. I think we'll see a lot more of that, and I think we'll see a lot more of that with private equity GPs from Saudi, from Abu Dhabi, and from other countries.
Before I let you go, I just wanted to have your view. There's been a lot of reports in the UK as well as in the US when it comes to private credit of having too much investment from insurers. Do you see this as a potential risk? Is it also the same thing happening in the region? And if you could explain also why some might consider that as a risk to our viewers.
Khalid, I wish we had that problem in the Middle East. Like I mentioned, almost all the allocators that have come in, at least to our fund, humbly speaking, this was their first time allocating into a regional private credit manager, right? And so if the most, dare I say, the most sophisticated, largest allocator of capital just started looking in this, but doing it in a meaningful way, the next layers, particularly insurance, haven't really moved into the same pace. We'd like them to. There's a couple of really well-established, long-standing insurance companies. We know them well. They've been active investors, but it's less than a handful. I mean, they're less than a handful. The rest have been a bit more, following things like indexed funds. Liquidity is a big thing for them, so they weren't going into private credit or private markets. They were doing more on the public side. So I think that Our insurance landscape in the Middle East, from an investment point of view, I think has a bit of room to evolve, and to actually embrace what the West has done. So similarly, before some of the pensions allocated to us and a few others, most of the regional pensions weren't really investing in any regional managers per se, unless it's a regional equity manager. And so what you're noticing now is a lot of these pensions now are allocating to private credit managers. So we are still far, far behind the West, which is a good news, because we're still able to accrete high double-digit returns without using leverage in geographies that our investors understand and know, in names that they understand and appreciate. And so while we're behind the West, it gives us an advantage to learn from some of the mistakes. And so while the West keeps, we read almost every day about private credit, the fear that, oh, there's too much dry powder, this is going to be the next bubble. Well, we don't even have that problem yet. If we, humbly speaking, as a 6-person team out of Abu Dhabi, are seeing $2 billion worth of deals, and we're only executing on 2 to 4% of them, and we still have over $150 billion of funding gap annually, we don't have that problem. I think, again, that's why I really stand behind my point in the fact that we are witnessing a serious renaissance in the Middle East, not seen since the day of the first oil well discovery.
Agreed. Last question. There's also you mentioned the banks and you're working. How do you position Islamic banks, the one that are Sharia compliant, towards what you are doing? And do you see a possibility of developing Sharia compliant products in the fund in the future, or is it something that is for you separated?
Actually, interestingly enough, we started off our journey as an ESG firm and an ESG fund, which we still are. And what you'll find is a lot of the Sharia tenants, aside from the loan values and using loans, actually, from a sector perspective, we were already naturally hedged for Sharia compliant investors.
Mm-hmm.
A few months ago, we were fortunate enough that we work with one of the most prominent scholars in the Middle East, in the Sharia scholar, and we actually received our fatwa for our firm and our fund to be a Sharia compliant fund. So the structures are possible, they exist, and they're observed by some of the most leading scholars in the Middle East and Asia. So they exist. The structure is approved. The availability of using Sharia compliant structures is available. So it's not an issue at all. It has evolved. Again, several years ago, this wasn't the case, but it's an evolving landscape, and now we've reached a point where we thankfully are one of the few Sharia compliant funds.
Okay, that's great. Omar, thank you so much for taking the time. I join my voice to yours, and I agree. Like what we're seeing in the region in terms of renaissance and development of new opportunity is very clear. And hopefully, the next time we talk, we'll have more stories of funding this gap and through Ruya Partners. Thank you so much for your time.
Thank you, Khaled.